Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to talk about a question in the comment section. I'm going to hit that one up. It deals with a comment that TraderFerg has made, and I'll give you my opinions on maybe why he thinks a certain way. And someone wanted me to get my opinion on it. So that's what we're going to talk about here. It's probably going to go into even a couple other sectors. And we can talk about it in general. So let's go over the question first so you guys can see the question. It's right here. Let me zoom in so you guys can read it. It says, Andy, can you cover TraderFerg's comments? He recently stated on Resource Talks podcast that the asymmetry in uranium has changed and oil and coal have it now. Do I agree, disagree? It might make for some interesting video for you to comment and analyze this premise. So I know TraderFerg. I talked to him. He is he's on top of his SHIT. Okay, he's really on top of it. And this is obviously going to be somewhat personalized to the person. So and he is right to some degree. So I think you can look at it from multiple viewpoints, and you can maybe glean different outcomes to some degree. So his style of investing, if you were to look at his style of investing is to buy basically dirt cheap bottom pricing. All right. For him, since uranium has come off the bottom, it's changed the risk reward profile. And it's probably entering an area where he thinks there's better opportunities in the market, and rightfully so. And I'll show you what that looks like. His approach is not the same approach as mine. We are different. So if you take a big picture view of uranium, this is on a monthly candlestick chart. You've got this big bearish decline, a bottom in 2016, and then a slow move up. And now it's starting to move upwards with vengeance, we'll call it, with a lot of momentum. Where he wants to buy is down here. That is where he wants to buy. He's buying it in the basing pattern of the blown out market conditions. Your risk reward as this goes up changes in a negative way for an investor. So when you look at the investment, your risk. So I'm just going to draw this on a blank sheet over here. Okay. So I'm just going to go over here. Got a blank sheet, guys. And I'm just going to say, like, let's say this is the reward and this is the risk at this price of uranium. All right. That's your risk reward. So this is your rewards up here, and your risk is down here. So RI is risk, RW is reward. Now, as the price moves up, and I don't know the necessary top here, if you're at this price up here, your risk is now changed to this chunk at the bottom, and your reward is now more even. So what he looks for is he wants something with a little risk at the bottom, and he wants something with gigantic reward. And that's your reward, your risk to reward ratio. And what he wants to invest in is this over here. He wants that. He does not want this, because the risk reward has changed, where uranium, at least futures pricing, has gone up to 70 something, low 70s or something like that. And it's a different risk reward to it. So he thinks that in the market, there are still risk reward profiles that look like this, where you've got a very little risk and a lot of upside rewards. And I do think that there are opportunities in the markets that possess this risk reward basis. If you look at guys who are really hardcore, even like myself, when we look at things, we don't like to chase. We like to buy patterns in the market. And TraderFerg's a little bit different than I am. I'm more driven by charts. He's driven by the fundamentals only. So he looks for things that are bottom crawling, that are coming down. A company that is still blowing out to the downside and the risk reward is still very great. Now, uranium has already moved up quite a bit here, guys. I mean, this here, the normal people are starting to get excited about it. And I hate to say it, but that's when professional investors stop to invest in it. They just let it ride. They're not taking new positions up here. That is not what the pros do. The pros are taking positions in something like natural gas or something like iron ore that people aren't even thinking about. They're buying stuff when people aren't thinking about that asset. So if I were to do something, I'm just going to show you. This is the BDI divided by uranium. This looks like this is down low, and it could potentially outperform uranium. Baltic Dry Index, shipping, dry bulk shipping. And right now on the website, we are looking at potential investments that are down here ready to rip. We can look at Baltic Dry Index versus gold. What's happened? It's a falling wedge and a breakout and a big outperformance candlestick, bullish engulfing. Dry bulk shipping against crude oil looks like it could potentially outperform. You do Baltic Dry Index against copper, could outperform, and it's really low in its ratio. Baltic Dry Index versus silver could outperform. And Baltic Dry Index against, this is iron ore, could outperform. You can see this thing starting to come out of its base here and ready to potentially move higher. So that's exactly the sector that we would look at. And we've got, if you look at history, this is your risk is this, and your reward to the upside is that. So your risk reward is blowing out. And that's why if you listen to him, he talks about dry bulk shipping and stuff like that. And I'm just showing you in a ratio format. Now, that doesn't mean that uranium's a bad investment at this time. We can obviously look at URA divided by UX1. And what we see here is a really low ratio where the equities haven't really outperformed the uranium's future pricing, the physical spot price. So there's still a ton of upside from a very cheap valuation. That is still in play. It is still game, so to speak. But I could understand his comment because he likes to buy things that are just absolutely blown out. And he might be looking at the futures pricing thinking that, well, maybe that's not as blown out as it used to be. The futures pricing has gone up. So this has gone up. And URA has only kept pace with the futures pricing. It hasn't outperformed the future pricing yet. And we're at still what I think is a very good low opportunity for outperformance for the equities. So I don't disagree with him. I think he's a successful investor, and I think he is completely right in his own mind. But the equities are still cheap. They are still cheap in my opinion, and there's still lots of upside potential. So everything we do, guys, it should be based off risk reward, exactly what he's doing. And what he's saying is that there could be better upside potential in other sectors. It's that simple. Whenever people start getting increasingly excited about an area, the sentiment has changed. Generally speaking, that's not the best time to buy. The best time to buy is when sentiment is really negative, and it's turning that sentiment. If you want to try to buy bottoms and you want to buy 10 baggers, 20 baggers, and 30 baggers, can't buy when everyone's excited. You want to buy it when everybody is not necessarily peak pessimistic sentiment. It's the sentiment is negative, but it's starting to turn around, and then the price starts to bottom and turn. We're going to get that type of market condition, I think, in silver companies. And we should be looking at, companies that are like SILJ versus the silver price. Because look at how low this is, guys. This is basically putting in a double bottom. Now, I understand that you like the normal public, all right? The normal public is not going to like this. Why? Because they don't have the price of silver to justify the excitement and the enthusiasm around it. So they're going to write this off. That's why a pro is going to wait for this to bottom. It's going to turn, and then you buy the crap out of it so long that the market conditions are right for it to turn. The market conditions are what is going to cause the turn in silver. And we can see that in the technicals, in the charts. Now, we've been trying to bottom by it. And another way that you can do it is you look at the ratios and you say, you know what, this is just blown out. I'm going to continue to add small amounts and cost average in over the next year or 6 months, or maybe it's even 3 years. I know a lot of people say that it's been down for, a decade. Well, yeah, that's exactly why we're buying it. And we're buying it because the market conditions are changing for these to revalue themselves in the market. That's why we are buying them. Now, you don't need to buy, let's say there's 5 sectors that are down, all right? There's 5 sectors that are down that possess the risk reward that I was describing. Small downside risk with a bunch of upside reward, right? Small downside risk, big upside reward. That's the asymmetric opportunity that a lot of investors look for. They want the big upside with little downside risk, okay? What if you've got 5 sectors that possess that risk reward? You invest in it and you know that the market conditions are changing for these to come into favor at some point. Now, a lot of people think that just because you're a professional investor that you can time the market with a degree of certainty that you only have to wait days or weeks for that bottom to occur. That's not the case, guys. Not the case. The very good investors don't know the exact timing of it. No one does. So what we're trying to do is we're trying to get within a few years of the bottom. But the symmetry in the asymmetric proportion of the upside potential and the downside risk are so blowing in the favor of the investor that you're willing to wait a few years for that to occur. It could be 6 months, it could be 2 years, it could be 3 or 4 years even. Now, if you've got 4 or 5 sectors and some of them may work under a slightly different market conditions, all you need is one of them or 2 of them of the 5 to get moving. The symmetry is so blown out in your favor that if you get 10 baggers or 5 baggers or 20 baggers in your returns in just 1 or 2 sectors, it carries the entire portion of the portfolio and you can still outperform the markets because the symmetry is so lopsided. Where you get into problems is when the symmetry changes and you continue to move up. People are going to FOMO into the sector. They're going to see that the price performance is moving and people are going to chase price. That is the fear of missing out. That is chasing performance. People or humans think that the performance move, like this, for example, that this is going to continue and that this is going to be the new paradigm and that this is going to extend on forever. So they do end up buying at these periods up here where it's a bad risk reward. So if you're trying to buy it right where it's at, your risk is really low downside risk. Let's just say your risk is this, but your upside potential is all the way maybe to this peak up here, right? So that's a big risk reward profile on this ratio of silver juniors versus silver itself. Now, I know it can still get cheaper, but your risk reward is good. The problem that people get into is that they chase price and that their risk reward buying it here is downside risk and your upside potential is really a lopsided thing. It's not an asymmetric bet at that point. It's a bet that is basically equal in risk reward. And guess what? You don't make as much money taking on bets that have more equal risk reward profiles. So the way that I identify the value in the market and these asymmetric opportunities is through ratios and the investing through ratios. So when I look at this, and here is one opportunity, you look at that and you say, you know what, this has a lopsided risk reward opportunity. Let's see if this thing can bottom and turn and buy into that strength down here. That is a strategy that I use. You can also look at, say, natural gas. Natural gas, I don't know if I've got a bunch of natural gas ones here. You could look at natural gas and price natural gas against a bunch of different things, like, for instance, the Dow Jones Industrial Average. This here is an underperformance in nat gas, outperformance in nat gas, underperformance. We've broken out of the downtrend line, and I think we are going to move to the upside over a longer period of time because the market condition has changed where nat gas is going to be moving higher. Now, this is really, really low. Look at history. This is probably one of the cheapest times that you can buy natural gas in the markets. See that horizontal line I put right where we're at? It's cheaper than the entire bull market of 98, 99. It's way cheaper. So some people will take the opposite view and they'll say natural gas is in a glut. Hey, that's when you buy it. You buy it when it's in a glut and that it's so cheap. Now, nat gas is so cheap against other asset classes. It's going to drag other asset classes down because everyone's going to burn natural gas instead of coal, instead of uranium, instead of renewables. They're going to burn nat gas because it's so cheap and the energy density is so good in terms of its returns, energy return on energy invested. We're going to burn the crap out of natural gas until it gets expensive. This is the one that they're going to burn until it gets expensive. It is under its higher cost producer cost curves. So it's going to squeeze up at some point, and it's going to go back up, and it's going to cycle. And we're also putting on a bunch of capacity to ship this out over the next couple of years. Liquefied natural gas terminals in America, and this is American natural gas, and it's also more expensive over in TTF in Europe. So here's some natural gas pricing just to show you guys what this looks like. And I am a huge natural gas investor. Why? You're look at down here, guys. We on the community, we've been buying natural gas companies down here. Your risk reward is gigantic to the upside. Nat gas is probably one of the best investments to be looking at because it is blowing out to the downside, and your risk reward, you're basically at the bottom of the risk, and your rewards are just massive. They are just massive. So when we look at this, you can see this is natural gas versus uranium. This is bottom crawling, guys. Nat gas is going to be, I think, an outperformer. Nat gas versus crude oil. Super cheap for nat gas to outperform. Nat gas versus copper. And guess what? We are getting some momentum behind it too. But we are at what I would consider to be just ludicrously low levels for nat gas. Nat gas versus Dow Jones, cheap. We went over that. Nat gas versus palladium. Palladium's outperformed nat gas, and we're just bottom crawling here, guys. We're bottom crawling at a very cheap ratio. Nat gas versus Baltic Dry Index. Now, this is going to be one. Look, you can see that this has basically been, here's the average. It's just been back and forth. But nat gas is cheap to Baltic Dry Index, and Baltic Dry Index is cheap to everything else. So, looking at this, nat gas is probably one of the cheapest investments that there is. They call it the widowmaker, but they also call it the money maker if you buy it at the right times. Would I take a bet on nat gas? Would. So what he's doing is he's sizing up the risk reward and the asymmetry in that investment. It's exactly what I do. And all extremely good investors do that. They size up the risk, they size up the rewards, and they say, well, this thing doesn't have much more to go to the bottom side. We're below the cost curve. They're going to be burning this wherever they can because it's the cheapest form of energy at this current time. And yes, I know, I understand. Uranium, it could be cheaper, but you have to build all these, these things. It's a long lead item. Nat gas, we've got nat gas plants everywhere, guys. We're just gonna burn it like heck because it's cheap right now. So That's what people are doing. That's what the pros do. Risk reward, buy at very cheap time, bottoms that people aren't looking at. People talking about natural gas as a good investment? No. People talking about Baltic Dry Index? No. Are people talking about uranium gaining sentiment there? The symmetry is being lost by it moving up. And as things move up, your risk reward changes. So that's what I've got, guys. Let me know if you guys enjoyed this clip. Give me a thumb up, subscribe to the channel. If you guys are interested in knowing what companies I'm talking about in natural gas and Baltic Dry Index and all these different areas that we are looking at, on the website and in our community, then join and find out. Find out how much the returns are. We've been buying energy service companies when they were blown out to the downside. Here, I'll talk about it real quick. So we can look at, say, something like we'll do OIH divided by mu, and this is a very easy one to kind of look at. We were buying a lot of these energy service companies right down here, where OIH, which is the energy service companies versus agriculture, we were buying the crap out of it down here, and look, it's starting to outperform. We can go down to all our OIH investments. We were buying it in this general location down here. And look what's happening. We're outperforming all the other sectors. So what do those types of returns look like? Well, from the bottoms, some of them are up 3, 4, 500% in a year. Some are up 100% or 150%. Depends when you bought it. Depends the. See, this is what's going to happen, guys. I'm just going to lay it out for you. All right. You're not going to trust the strategy in the beginning because it's new to you. Once you start using the strategies that I'm deploying and you start getting comfortable with it, you're going to get better and better at investing because, one, you're going to trust the ratios and the strategies and the technical analysis. Two, you're going to start to get that confidence in yourself. You're going to know how to play the game at some point. And once you start to figure that out, it becomes invaluable. Why does it become invaluable? Because you know how to play the game. Knowing how to play the game is absolutely everything in this. Because the time frames are a little bit longer. They're not days or weeks. We're not trying to short-term trade this. We're trying to get 10 baggers and 5 baggers and 20 baggers out of the market. When you start to see my approach and you start to see the strategies, and then you start to see potential returns in your own portfolio, things will change in your outlook. Your paradigm is going to change completely. And you're going to say, this is the approach I should adopt. Because you're going to see success in some approaches, and then you're going to see failure in other approaches, which is the normal learning process. So I'm going to show you how to do it. You're going to have examples of companies that I'm buying. You get to see what I buy, when I buy it, and you're going to see the returns I get. Then you're going to start to say, dude, this dude's got a lot of money. Because you're going to be like, holy crap, this is going up so much. How is he doing this? And then you're going to know how I do. And then you're going to see firsthand why I'm choosing specific companies, what the risk reward profiles are. Why am I choosing these larger companies that have the same upside and versus these smaller companies that have a lot more risk? I'm favoring probability and returns over the risky stuff with big amounts of money. I still go after some of the risky stuff. It's in my portfolio, but I'm not overweight that. I'm not overweighting the high risk stuff. I don't want the risk. I want the returns without the risk. And that's what you're going to see with pro investors. They're going to favor probability. They're going to favor the returns with higher probability over the risky stuff. And retail investors, they do the exact opposite. They hope and they pray for the rainbow type stuff and go after the high risk stuff. And they don't overweight the probability of success with good risk reward returns. That's another difference between the two. So if you want to join, go ahead and join it. I've got the September coupon code if you'd like, which it's going to run out here in the next few days. If you want to try it for 1 month. I also have a discount for those that have been with me for a little while. If you want to sign up for a year, I also have a bigger discount if you want. Message me through the website or through my email, and I can hook that up for you guys if you've been with me. And I'll take care of you if you've been with me for close to a year. If you've been with me for 7 months, 8 months, I'll still give you the discount if you want to sign up for a year. What I'm doing is I'm literally I'm looking at everything that's bottoming out, getting them in their basing patterns or breaking out of their basing patterns, where we could get big moves to the upside, and we're buying them. And people, they change their mindset. It's almost like they adopt completely how I'm adopting it, from what I've seen. So a lot of people will ask me, what does this chart look like? And really, they give me a chart that looks like this, and they're like, should I buy it up here? And I'm like, no, 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 no. You don't want to buy it up here, guys. There's too much risk. There's too much risk. But I would buy it down here. And if you notice here, guys, if you really want, throw a line across. This is really a shoulder, a head, and a shoulder that's broken out to the upside. And it's running right now. That is a bottoming pattern. Now, there are laggards in energy service that we can still buy that are energy service companies of maybe other companies. Maybe it's drilling companies. Maybe it is energy service companies that provide services to energy service companies, like companies that make the drill bits, or companies that make other things for other companies, or they have like machines or something that do stuff for energy service companies, like the drilling companies. So it's a service company to the drilling companies, which lag behind. They are still putting in their inverted head and shoulders and other basing patterns that we see. So they're very low risk with a lot of high upside potential. Your symmetry is there. So that's exactly what we do on the website. This guy here, finding-value.com. That's what we do. And then you wait. You're going to wait. These take some years to play out, and then you're going to see the returns that are going to be mind-blowing. So that's what I've got for today, guys. Thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.